So welcome back, guys. This is almost like a second part to the video that we had done earlier, which was on course correcting your retirement planning journey. In case you have not watched the video, do check it out. While this video stands on its own, but it does help if you have some context before getting into this. So in this video, Karan, once again, thank you for being here. In this video specifically, we are going to cover the journey of be it retirement planning or investment planning in general, with or without the use of professional help. Right. So I want to understand, because I know that we also are technically a professional, service when it comes to investing. But I want to be as objective about this whole thing as possible. When and where and for what kind of a person would professional help actually make sense, where it might not. So we want to get into all of those aspects to dive deeper. So starting with the very first question to get some insight into this whole process, I want to start by understanding the trade-off. And when I say trade-off, I'm talking about the trade-off between doing this entire thing yourself versus getting a professional help, right? Trade-off in terms of time, skill, objectivity, you name it, right? So how do we try and analyze this trade-off?
Thing is, like all the fields, whether it's a legal field or medical field, okay, in building construction, investment also come with a certain expertise.
Right.
Basically, this field also requires certain expertise.
Know-how.
Somehow, at some places, you can replace this know-how with experience as well.
Right.
Okay. With experience, so let's say you start in your 20s, early 20s, you make some mistakes, okay, you learn from them, you course correct, okay. Then gradually over the 5-10 years, you refine your investment strategy, okay. So if you're starting very early in your 20s, okay, you still have time to refine your strategy, okay. Right. You can spend some time, okay. Responsibilities are less typically when you're young, okay. You can spend some time, you can read books, okay, you can do some courses, okay, develop the technical jargons, okay, see what successful investors are doing,
Right.
what is happening in the market, which investment calls have worked, which of your calls have not worked and why, and smooth it out. And after 5-10 years, you have a strategy in place, okay, and you can do it. From there onwards, your most of the time and skill set that is required, those all limitations that are there in do-it-yourself space, those are mostly taken care of.
Right.
Okay. And you can manage the money on your own. Okay. But the problem comes with this approach, even if you do that, even if you're starting in 20s and you have a refined strategy and everything that is in place.
Right.
Okay. The problem is you have a particular style. Okay. You cannot master each and every aspect, each and every aspect of the investment. Okay.
Right.
You have expertise in certain segment or certain sector, a certain type of companies or stocks. Okay. So ideally, if you want a real diversification, real diversification is a style diversification.
Right.
Okay.
Okay.
So some people, despite having decent experience in stock picking, most of people, even if they are do-it-yourself investors, they go for mutual funds.
Correct.
Okay. They go for different mutual funds. But here also mutual fund selection is much more tougher. I would say less risky, but tougher with lower success rate. Mutual fund selection has lower success rate than stock selection. Because stock still has some fundamentals. Okay. You can make some predictions. Okay. Your analysis might have some gaps.
Right.
It might have some gaps, but there's data out there, business out there. You know what is the market share, okay, how the balance sheet is, how the incomes are, what is the growth rate. You know the fundamentals. Everything is out there. Hundreds of people are covering company. You know what they are saying. Okay.
There are some objective data out there.
That is out there, and that allow you to take a call on a firm.
Right.
Okay.
Right.
But how would you judge what a call manager is going to take? How would you make sure that your manager that you're selecting is a winner?
Right.
Okay.
Right.
So even if you go for do it yourself, I would typically recommend, usually mature investors also do the same.
Right.
They have some 20-30% portfolio with them, which they manage themselves in line with their refined strategies. Okay. 70% they basically give it to other managers. Okay. In some cases, they go for mutual fund selection. Okay. They only give it to mutual fund managers, different mutual fund managers. And gradually, as your corpus grow, in 30s, let's say corpus is smaller. It would be relatively smaller. It would be around, let's say, 1 crore, 2 crore, mid 30s. Okay. It would be 1 crore, 2 crore. So there, even if you take 70% portfolio, it would be somewhere around 1 to 1.25 crore. Right. Okay. So mutual fund is the right vehicle for that, for the diversification. Okay. So you have you put it across the different mutual fund managers. Okay. Again, I'm saying the success rate there would be much lower than stock selection.
Right.
Okay. So as you were...
but it still gives you a diversification.
It gives you diversification, a different approach.
Right.
Okay, you might be good at picking large cap companies, long-term stories, okay, blue chip, but it might be alpha available in micro cap or small cap space. That might not be your cup of tea. Okay, and second thing is that mutual funds, as they are managed by professional managers, they come with inherent discipline. Okay, in their investment approach. Okay, so even if your portfolio has high churn, and there is some conviction-based buying or some emotional-based decision that is there, you can limit the damage if you diversify some 60-70% into mutual funds.
Got it.
Okay, as your portfolio grow further over time, by the time you reach 40s, okay, your risk taking capability goes down significantly.
Correct.
Okay, now your corpus might be larger, it might be 4 to 5 crore. Okay, but your exposure might be restricted on do-it-yourself basis to the large cap, ideally.
Correct.
Okay, because you, so in this case, what happens? You can take the service of portfolio managers, AIFs, as corpus is larger.
Correct.
So let's say you can put 2 to 3 crore to different portfolio. You can distribute it among portfolio managers where ticket size is around 50 lakh. Okay, you can take the diversified approach, go with 5 portfolio managers. Okay, and that's how you can take it forward, build the process. Because I'm talking about portfolio managers as such. Okay, in 40s. Because your risk-taking capability is low.
Right.
Okay.
Right.
So with portfolio managers, you are taking the help of people who manage large money. Okay, big money. Okay, and you are taking the risk through them. It's filtered through their expertise. Okay. So on lower allocation, on lower risk, you have to make big money. Okay. So that's why PMS schemes make more sense when you reach 40.
I want to just double click on this particular aspect, right? And get a little bit deeper into choosing the kind of financial professional help that might actually make sense for you, right? Because there are different kind of professional services out there, right? Like from a small financial advisor to a mutual fund wealth advisor to a PMS like the ones we are, to AIFs, to even family offices. Of course, not everybody's makes sense for that, but then there are different levels and categories of professional help available. So how does one decide, right? What are some of the thumb rules that one should kind of ask themselves before they decide that, okay, this kind of professional help might make more sense?
When you're going for professional help, you're going for diversification, right? You can manage your portfolio, you have some model, something like that, but you want to diversify,
right?
Okay, you want to have some, basically it's kind of a very good risk management technique,
right?
Okay, so when you're going for diversification, you are not going for fund managers, you would not go for fund managers who have the same style,
right?
Okay, you will basically go for funds that have low correlation. Okay, that's the ground rule of diversification, right?
Yeah.
Okay,
absolutely.
You will make some allocation to international equities. Okay, you will go for fund. So basically, there are different factors which are out there. Okay, some funds call them, some follow value philosophy, some follow growth philosophy, some are large cap, some are mid cap, some are small cap. Okay, some are micro cap. Okay, some follow momentum strategy. Okay, so you basically go for first thing is to basically categorize fund into different categories. Right. Okay, that's the starting point. Whatever options you have, 10, 12, 15 options, you have to differentiate between them, divide into them different categories. Okay. As per the investment philosophy. Right. Okay. Then the second point is, then you have to do the fund selection from that particular category. Fund selection may be different, might be consisting of multiple steps. Okay, I would put my neck out and say that very clearly, there is no short way of fund selection. There is no short winning way of doing a perfect fund selection. Because a manager, if two value managers following the value strategy or value philosophy, they might have extremely divergent returns. Even in the mutual funds, you see.
Yeah.
I was looking at mutual fund data some other day. I was looking at the year 2024 actually. So one mid-cap mutual fund gave 59% return. For the same year, one mid-cap mutual fund gave 11% return. Yeah. So that's the diversification, that's the divergence you are looking for.
Right.
Okay. And so you have to go for fund where you have access to the fund manager. Okay.
Right.
Typically, the funds which are in the, I would say, mid segment, extremely large funds, you might be speaking mostly to the sales guys. Right. Okay. If you're coming with this very small corpus, let's say 50 lakh or 1 crore, you might be, so you would not get access to fund managers, because if fund is a size, let's say fund size is 5,000 crore, 10,000 crore. Okay. So they would have more time for people who have 15-20 crore, who are putting 15-20 crore, right? That's a pure business sense.
Yeah.
There's a pure business sense. So a person who is running a fund of 100 crore, 150 crore, 200 crore, they would appreciate if somebody putting 1 crore.
Yeah.
In that case. Okay.
Well, that's like 5-10%
so
of their book.
You need to go for a fund where there is a fund manager who has time for you. That's most important. Okay. Because then you can judge whether this fund manager, their philosophy, what they're talking about, it is making sense for you or not. Okay.
Correct.
The only way you can approach fund selection, once the categorization is done, to take your call about fund manager by understanding his philosophy, okay, understanding his vision, what is his view on the market,
right,
okay, and whether that whether your conversation with the manager give you confidence that this person can deliver on the return potential that you're looking for.
Right. But from age is also a very important factor that comes into play when it comes to deciding whether you need professional help or not, right?
Santosh, let me put it up bluntly here. Whether you need professional need or not is immaterial. How much money you have in your pocket, how much money you can put on table, that all matters. Okay. So if you have a corpus of 2-3 crore, okay, whether you are in your 20s, 30s, 40s, nobody is interested. I would say 2-3 crore these days people are interested still. Some PMS, some banks might call you for some PMS, selling some PMS and all. But mostly people are not interested in offering services or any kind of advisory. Okay. It's not available. It would be actually too costly for you to go for that. Okay, that
because of the expenses.
Because of the expenses, getting an advisor, hiring an advisor, it's a costly process. Okay. If you have a corpus of less than, let's say, 10 to 15 crore, you might be able to afford an advisor, investment advisor. Otherwise, very difficult. So mostly people are left at the mercy of distributors, mutual fund distributors. Okay, who are relying on huge commissions from NFOs.
Right.
So some mutual fund distributors might be doing a great job. Okay, they might be helping their investors. Okay, and everything, but there is always a conflict of interest there. Okay, there's always a conflict of interest there. So the best hope for people irrespective of age group, okay, is to diversify their funds at some point of time, okay, into different PMS and AIFs. Okay. So even when you talk about PMS, there are PMS these days who cater to mutual funds also. Okay, who do mutual fund selections as well. Diverse type of offerings are there in the market these days. Okay. Ideally, 20s and 30s people can do it on themselves because corpus are quite low. Okay, return requirements are they can take risk on by themselves. Equity allocation is quite high, 80 to 90%. Okay, equity allocation would be there. Okay, in 20s and 30s. Even there would be a bias towards mid cap and small cap. Yeah. Okay, so there's a high risk taking capability which is there, so they can do it on themselves. Yeah. Okay, so even if 15 to 20% return is coming from a composite portfolio, that's fine. Even you go for the index funds, you can make it, right? But once you reach 40s and 50s, your equity exposure goes down. Okay, gradually it comes down to 40-50%. Right. It's there
because of your risk.
Because you cannot take risk. Yeah. Okay, so your equity exposure ideally go down. So what do you need? You need now higher returns on that equity portion. Okay, you need higher returns on that equity portion to facilitate that higher return. Either you can go into extremely risky segments, increase bias towards small cap and micro cap. Right. Okay, but that would be very risky for your age profile. Yeah. So the best way is to diversify, give it to professional managers.
Right.
And if you have big money, let's say there is a 2.5 crore that is there, you can actually diversify among those managers as well. Okay, because you want your money to make to deliver higher returns at lower risk. Correct. And that's where these guys come in. It's quite possible that they might be able to deliver, might not be able to deliver. That will give you a better shot.
In the end, though, I still want to touch upon on the whole do-it-yourself kind of people. Suppose even in their 40s, whenever it may be, suppose if they still decide that, I would like to manage my own portfolio, but they would still like some sort of a professional guidance in terms of how best to go about it. What would be some of the things that you would advise them to look out for?
See, I would advise them to go with a stepwise approach. Okay. Every 5 years, they should increase the debt allocation, reduce the equity allocation by around 10%. Right. So let's say at the age of 40, because they have some already some debt exposure through PPF, right. NPF, NPS. So I would suggest they would be sitting at 90% equity exposure in their portfolio at the age of 40. So as they you go 45, they should reduce it to 80 equity exposure, then 70, then 60. So
this is the asset rebalancing.
Asset rebalancing that should be happening. Yeah. Okay. Second thing, I would recommend. In general, we recommend clients who go for DIY, okay, who don't want to go through PMS route, and when we meet, and we typically advise them to go through index fund route.
The broad market.
As I already mentioned, there is no There is no winning fund selection formula that is out there. What most of people do, they basically go to the direct fund platforms. They see, okay, which is the best performing fund in last 1 year, and they go for it. Right. Okay. Mostly there's a mean reversion. Every manager, there's a mean reversion. So whoever is the best performing today, okay, would not be best performing.
Right.
Every year they cannot be best performing, right? So more often than not, funds which end up in top 5 in their category in a particular year, in a year Y, typically end up in last quartile in year Y+1. Okay. That's how it works. Okay.
That's been the pattern.
That's been the pattern. So rather than going for taking the fund selection risk, especially in large cap and mid cap, rather than going for fund selection, because even the alpha is not very significant. If you look at the category, mutual fund category, alpha is not significant. And alpha is going to diminish over the next 4-5 years. It happened in US, happened in Europe. As the coverage increase, computational power increase, market participation is there, corporate governance norms improve. Okay, this alpha is going to disappear.
The anomalies are
stock picking, the anomalies that used to be bread and butter. Okay, they will disappear. It's not that managers are not capable.
Yeah,
it's just that it's not feasible.
Right.
Okay, so this will disappear in large cap and mid cap. It's already disappearing, decaying.
Right.
Okay,
right.
It will become even less. Okay, that alpha will become more insignificant over time, and it will enter into small cap space. This phenomena of alpha decay. Okay,
right.
So so we typically build a portfolio whenever they ask for an advice. We typically advise them on a portfolio of index funds.
Okay.
There are around 100 index funds which are out there. I think it's more than around 200 index funds which are out there right now. Index funds and ETFs. And even if they want higher returns, okay, there are factor funds which are out there. If you see momentum, alpha, low vol, dividend, quality, there are multiple funds which are tracking these factors. And these factors deliver alpha without exposing to size risk, which is small cap and mid cap. Small cap, mid cap come with small cap and micro cap come with their own risk.
Right.
There's a corporate governance risk which is there. Okay, businesses are quite small, so different kind of exotic risk that you are exposed to. Factor portfolios, okay, can deliver that sort of alpha that is delivered by typical small cap fund, while restricting exposure to top 200 companies mostly. Okay, so we advise them to go for a mix of broad index funds in large cap and mid cap. Okay, if they want, go for micro cap and small cap mutual funds. Their alpha is there. We admit that stock picking alpha is there.
Correct.
Okay,
but it comes at a higher risk.
At a higher risk, and if they want to don't want to take that risk, some 20% allocation, but that risk they want to, they can go for high risk factor portfolios like momentum and funds.
Got it.
And even on the index fund side, they can improve the risk-adjusted return by going for low risk factors like quality, dividend, and low vol. Okay, so that's the mix we typically advise people to go for.
Okay, fair enough. So I hope that gave a good idea in terms of the do-it-yourself approach versus the professional help when it comes to investing advisory. If this was helpful, do let us know in the comments. And like I mentioned, do check out our earlier video, which was almost like a preamble to this video, which was entirely about retirement planning, but especially focusing on if you happen to be a little late in the game when it comes to your retirement, then how do you actually course correct and get back on track? Once again, thank you, Karan. See you next time.